Well, in inflation, a lot of times we are always concerned about short-term inflation because short-term inflation is very real. When I mean short-term inflation, I mean right now, the inflation that we are facing. But I think what investors should really be worried about is more long-term inflation, because long-term inflation eats into your cash, it eats into your investment returns. And, if you're planning for that big event like a retirement or funding your children's college, your children's university, then it's very important to actually beat inflation. So I think to beat long-term inflation, it has been shown that equities is the best instrument to use to beat long-term inflation. So there is a need to definitely invest into equities. I know that sometimes it's a bit uncertain in the short term, but again, there are enough evidence to show that in the long term, the equities market, the global equities market, if you diversify your portfolio, it always goes up. So I think it's important to invest in equities to beat inflation in the long term. For the short term, one way to mitigate it is to put your money not just in cash in savings account, but in short-term instrument that in the meantime gives you higher yield, high interest rates. Today, the good thing about the current interest rate environment is that whilst, debt, you have to pay more in terms of interest. Well, the good news is that the short-term, or rather the interest rate for short-term instruments such as the fixed deposits, even treasury bills are going up. So I think if you have got cash, especially cash in your emergency fund, these are places whereby you can park your money.
And to that point, Chris, what are you advocating your clients do right now with regards to buying investment properties? Because, for example, if I buy a property here in Sydney to rent out, I'm only going to get an average yield of about 4%. But to your point, I could just park my money in the local bank and get 4% or more for doing nothing with none of the costs associated with running a property.
Yeah, I think that's a very good question. There are two things here. Well, one is short-term and one is long-term. Whilst the short-term instruments right now, like T-bills and FDs, the interest rates are good, but it's going to only be present. It's going to be only here for a short term. So if you're looking for a longer-term, higher return, you can't park your money into cash. You can't park your money into treasury bills or bonds, right? You've got to look into something that gives you that higher return in the long term. So, of course, besides equities, investment property is one consideration. But the problem with investment property is that a lot of times, especially in my part of the world, the yield comes from the leverage that you take. So I guess you've got to ask yourself whether you are prepared to take that loan, because that may affect your financial health. And also for property, not many people can afford 1, 2, 3 properties. And if they buy that property, that probably takes up a huge part of your asset allocation. And you might run into a risk of putting your money into into just one asset class. So I think you've got to consider that as well.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to the channel for more. Thanks for watching.